We are recording, I think. Well, it says we are, so we'll trust it. Good morning to you, my friend.
Hey,
nice to see you.
good morning.
We are in.
Hadn't talked to you since yesterday, so but not today so far.
That's right. We are in the middle of August here.
Yes, sir.
Almost 8 months through the year, almost 2/3 of the way through the year. That's it's pretty remarkable when you consider. It seems like yesterday that we were dealing with the COVID drawdown and here we are, almost 5 months later, still in partial lockdowns and still trying to deal with this disease and still with people out of work and restaurants closing. I mean, it's a dangerous world out there. And
Paul, I had an interesting observation and reminder this week that I have been married for 53 years. And that's a pretty good milestone for me. I told my wife, I said, it's 19,246 days that I've been married to you. So let's keep working at it. That's all we got to do. There's a chance. There's a chance.
50 years. Well, congratulations.
That has been kind of fun. We've had, I never thought I'd live to be 53, much less be married for 53. So,
yeah. You think it's going to last?
Yeah, oh yeah. We're working at it pretty hard.
Yeah, we're going to hit 47 years this year. In fact, that comes up in, glad you reminded me, comes up in 13 days or so.
I'll have a little reminder for you.
Actually, it comes up in 11 days. 11 days, I get it.
Right.
I guess I better start thinking about an anniversary present.
Oh, well.
Oh, well, yeah. Well, it takes work, doesn't it? It takes work to manage a relationship for that long. And, I think that there's a point at which...
It's probably one of the more things that I'm most proud of is the fact that just like the markets, we have we take the wrong turns every now and then. We come to fork in the road, but we figure out how to get it straight and move on. And that's sort of leads me right into my questions for you that I always ask you.
All right.
Give me a little idea about the quarter-to-date returns, maybe year-to-date returns, and if you want to go out to 12 months or some other, just 2 or 3, just to be sure that we're focusing on long-term returns, stable returns.
Yeah, I'll do that. I'm going to do it without actually sharing my screen or anything because I've got it up in my email client here. You and I get these reports every day, calculated and emailed to us. We watch it, every day and compare our models with our accounts and our models with the markets and our accounts with the markets. We kind of live and breathe this stuff. It's been an interesting month this month. We've seen the S&P is making, almost a new high. It got within about 10 points of making a new all-time high earlier this month. But the NASDAQ has struggled. Just give you an example right now. I'm looking over here at my market screen, and the S&P is flat on the day. It's actually 0.000% change. And but they
overslept today, I think.
Yeah, right. It never got out of bed. The NDX got out of bed and took a fall. It's down 40 basis points. That's not a big difference overall, but it gives you an indication that the NASDAQ, the more tech-heavy stocks are struggling a little bit right now. But that's, of course, they've had a tremendous run-up. You and I are sitting on some pretty substantial unrealized capital gains in our portfolios because of that, and we're happy about that. And it leads me into taking a look at should you be upset about a given day's performance? And the answer to that is obviously no. If you're paying attention at that level, even though we do, we don't worry about a given day's performance. We don't worry about a given week's performance. We're looking at when we have designed portfolios for folks, we're concerned primarily with drawdown. That is the downside risk of the portfolio, and are the real-time accounts or the portfolios behaving in a way that would push them beyond what we expect in terms of risk.
Right.
The answer is, boy, absolutely not. Where everything's well within the parameters. And then secondarily, we look at the return profiles for these portfolios, and are we failing to achieve what we targeted? And there's not a single one that actually is underperforming itself when you start looking at quarter to date, year to date,
Right.
last 12 months. Everything is performing exactly like we want to, or outperforming. We've talked about the stable risk portfolio, which is our least um, our least volatile blend. It's for folks who are interested primarily in just getting some kind of reasonable return without having to worry about sleeping at night. When we look at that year to date, and we target about a 5 to 6.5% annualized return. We look back over the last 12 months, it's up 11%. So, year to date, it's at 9, and the current drawdown is just 45 basis points. It's right in line with what we hope. It's outperforming our models. That means there will be a time where
That's
we'll
right.
have a mean reversion.
A little bit, yes.
Yeah, it'll stumble, but it's right. These are difficult markets.
The thing, Paul, that I think is really important is that on a day-to-day, even a week-to-week basis, there's an awful lot of noise. Noise is news reports and blurbs and things that come in. It causes the market to, over some guy's report that doesn't mean a hill of beans in the bigger. So it's forced us to absorb daily noise or weekly noise or opinions. Everybody gets on one side of the boat real fast.
Right.
Well, then they say, oh, well, my bad. No, I didn't really mean it like that. What do they say? Walk it back. They got to walk back there. So
yeah,
that's one of our reasons for that we don't act on.
Well,
things.
you and I were talking about this earlier this week, and we kind of went back to basics on what is built into our approach to investing right now. That we've designed these things because we're old guys. We've designed these things because we don't want to have to recover from huge losses. We've designed these things because we want a stable return that's done without a significant or more risk than we're willing to take it at our age. And we reminded ourselves that there's a bunch of things. I don't know if you recall that conversation, or if you can name any of them for me.
It was actually kind of fun, because I got to go in total disclosure and say I was crying about how some of our stocks was, and you, like my wife, subtly bring me back in. I caught you reel you back in. So I got two people that ping on me. So, but it was really an interesting conversation. It really started about just what I alluded to: short-term performance versus, and then I look at my portfolio and I said, I'm up 20-something% year to date, and I'm thinking, I ain't that smart now. And we went through a lot of short-term being good and being bad and whatever, and it kind of alluded me to the. You brought me back in, as you said, because we have certain things that will never change ever. Right. And probably the first one, there's two that really jump out at me, and I'm gonna let you take one. I'll take one. Is the eternal battle for volatility control.
Yep.
Turn my phone off.
Is that President Trump calling again?
And the other one is just bullish and bearish regimes, and that's one of my favorite things to talk about. And it doesn't happen too often, so I get plenty of time to go fishing and hunting and stuff in between. So, give us the heart and soul of volatility control, and you may have an example or so or something.
Yeah. In terms of volatility control, given that these portfolios are, we start with let's manage the downside risk. Part of that is managing the volatility in the portfolio. How much does it go up every day, down every day? It's the eternal battle, as you said, is you want to miss you don't want to miss markets that are crashing up, but you don't want to be participating in markets that are crashing down. It's hard to balance those two, and we manage that in our portfolios a couple of ways. The first one is that we have a significant part of our portfolio in a stock selection basket that filters for volatile stocks. We filter them out, and we only select stocks that are non-volatile but that are moving in a positive direction. The second thing that we do is we use blends of different strategies in order to control, so that one strategy, if it has a tendency to do certain things in certain different kinds of market conditions, we've got other strategies that balance that out, that act differently. And there's one last thing, and we don't often talk about it, but we use a hedging component that says when the markets are so bad that it's difficult to make money, we don't want to step aside completely, because if you don't have any players on the field, you can't participate in the game at all. But what we do is we go into defense mode, and we use a hedging component that mitigates the volatility, either up or down, and that helps protect us against some of that downside risk. There's other things too that we exploit. Things like momentum. We look for stocks that are moving strongly to the upside, and we select stocks that are doing that. We use concentration of our assets, and this is the one that goes against essentially most primary conventional wisdom, which is that you should be broadly diversified. But you and I know that our research has said, one of the ways to broadly diversify is to own an index. And so you can buy a Vanguard total market fund, or you can buy SPY, which is the replication it's an ETF replication of the S&P 500, 500 different stocks. And most of the movement of that market comes from a small percentage of the stocks in that index. And we want to own the ones that are moving up, and not all the others which are dragging down.
Well, that there was a couple of great articles recently that I can't quote them because I'm not looking at, but something like maybe just a minor number of or attribute all of the gain in the S&P 500 or the NASDAQ 100 or whatever you might be. Very, very few stocks. And I mean, like 20 or 40 stocks. I mean, the average life of a stock on the S&P is 7 years.
Yeah.
Well, that means when you own something that they could be really not very helpful to your portfolio. So right. By our concentration, we only we own exactly what we want. I mean, if it's anybody at fault, it's you and I. I mean, because we pick exactly what we want to own in our portfolio.
That's right.
And we know, I think we know that for 21 days, that's how long they have on a monthly basis. We make decisions. They better get in gear or they're going to get gone.
Right. 21 market days. Yeah. Yeah. We reevaluate what I think is exactly the appropriate amount. Doing that daily, doing that weekly, at least in the way that the things that we've tested, means that we're going to participate in a lot of the noise that you earlier spoke of. But but by doing it monthly and centering our trades around when most of the huge players in the market are rebalancing their portfolios, we take advantage of being able to swap out those that are providing the most upside momentum at any given time. I'm going to share my screen if it's all right with you. I'm going to bring this up and have you talk about something that it's kind of an illustration. It's a portfolio that we have. And let me do this here. Share my screen. and bring this up. Talk to me about what this is, Don.
Well, this is a crude example of what we would really like. And you'd say, well, it's going from the lower left to the upper right, and that's not a straight line by any stretch, but it's a pretty, there's not many years that it doesn't have a positive return. And as a single line, this is strictly simply an example of what stable volatility can do for your portfolio. While it's not exactly all the things that we do, it's a major component of everything that we believe in.
Yeah, it is. There's, you know, we have on many occasions talked about the perfect investment. This is about as close an approximation that you can get to that. Like you say, it's not a perfectly straight line, but the zigs and zags are not that big. And there's a couple of things that need to be mentioned here. You know, why is this attractive to an investor? Well, like you say, there's not many periods where you're down. We're going to look at another slide in a minute where there's a better way to look at the down periods and how long they last and how far down they go. But the most important thing in here that it's a basic of investing, and it's one that escapes most investors, and that is, if you can avoid losses, you don't have to have a high octane portfolio to make money over time, because you're not spending much of your time digging out of holes that you've dug for yourself. You know, I could remember being a young investor and having a strategy that actually I still use it for a very, very small portion of my investing. I've been doing it every day, and it has a possibility of trading every day. I'm actually tired of it, but it has like an 18% annualized return, but it has a 40% drawdown in there. And I used to think, who wouldn't sit still for 40% loss of capital as long as you thought that you were going to get somewhere around 20% annualized return? And I don't think that way anymore.
Wait till you start drawing Social Security. It changes a little bit.
It changes, and I did not understand that as a younger man. It took. I had to get some of my rough edges knocked off. And that year to date, it's up, almost 50%, but it doesn't have many years like that, and that doesn't mean anything when you spend time crawling out of 30%, 40% holes. So, overall, I'm glad I have it, and it doesn't correlate with anything else in the universe. So it's a little bit of a diversifier, but I'll tell you, I have less than $10,000 in that thing because I can't stomach the drawdowns. So I mitigate those by just having a small amount of my money in there. This one here, it's hard to tell because there's not any really indicators on here. I'm not sure what to guess about what the annualized return on this thing is or what the maximum drawdown is. But I think the next slide is going to tell us, isn't it? Let me flip to that next slide and you talk about that.
Ooh, okay. Well, it is the typical S&P 500 in the dark, and an example of a stable volatility. And I think it's pretty easy to see that the first set of numbers are just total return, which you can look from bottom left to upper right. But the real takeaway is that they have close to the same compound average return.
Yeah, there's some way here you can turn on the
yeah. Don't
commentary.
worry about it, Paul. I'm talking fast today. I took my pill this morning, so our compound returns is the second chart. Both of them around 8%, but the third one is exactly the most important one. Right. It only went through a maximum drawdown of about 5% versus a 56% one of the averages, and that my friends, is the heart and soul of what we do. And we think that over time, it proves itself out. You say, well, you know, what about if something we hadn't had that big down move back in '08? We would have underperformed, but we still have less drawdown. And so
Right.
it's just this is not, this is just a part of, just an example of a component of every portfolio that we are responsible for.
That's right. And I'll make this note that, you talk about this area here from the left of the chart all the way up, here into the end of 2007, when the market turned over. It was a period of, I would call it, remarkable underperformance by stable volatility. But of course, this isn't built to outperform the markets in every case. It's built to manage the volatility. And over time, like you say, if we hadn't had the global financial crisis, this green line might not be, outperforming the market for most of the last decade. And it might not be above the market. I mean, these are roughly the same returns. But I've got to ask anybody that's looking at this, because you and I ask ourselves this question, and that is, we've got roughly the same percent return. Let's call them the same thing. How would you prefer to get there? I mean, if you knew that you were going to be looking at 17 or 18 years of investing, and you expected to have periods like this in any given 2-decade, span of the market, then how would you like to get there? Would you like to get to, about 8.5% performance by losing half of your money at one point, or losing a third of it? This was a 36% drawdown over here. Would you like to get there by doing that, or would you rather get there by doing this and following that green line? And the answer for us is, the green line's the obvious answer. That's what we'd rather do.
As I would say, let me think about it green.
Yeah, right. Yeah, give me a minute to think about it. Okay, I've thought about it.
Paul, I don't know if you can highlight the last earlier this year. Look at the top right of your screen there and see what the markets did. That was a 33% correction, and the little stable volatility example just marched right through it. I mean, just marched right through it.
Yeah.
And
it had a little bit of a blip.
Yep. But it's like me. I get off track on every now and then, but I got a couple of people that drag me back in line again pretty fast. So
there is this. You can see right here at the very, very tail end, and with this struggle that the Nasdaq has had, and the S&P is up, and this little thing is what kind of you woke up one morning and said, this is going to upset my day. And we took a look at it in light of where we are relative to the last several months, and came right around back to the point that, hey, look, that little thing there means nothing given what where we are. And that's why when you asked me today, how's everything doing, I went and looked at the longer term returns, the year to date, the 12-month running returns. And there's another way to look at this in terms of illustrating the risk versus the return. So let's look at the next slide, Don, and tell me what we're looking at here. I think it's coming up. There we go.
Well, the red line is just the amount of volatility that we've had to deal with. These are extreme volatility levels. And the blue line is the little stable volatility example that we have. Mm-hmm. So we're never too far from getting back to where we can make some money. And if you look at the bottom of '09, when we bottomed there with the market averages, that it was years and years to get back even again. So it's just our belief system is based on that component, and it'll never change. because
Right.
I've got too much math and too much work done. And if you ask anybody, uh, they want to know, what kind of return can you get for me? Well, I don't think we can guarantee anything,
No.
but our chances are a whole lot better, especially if you move it out for a few years to accomplish it with a lower volatility component.
That's right.
And I guess I always say this, but I always mean it. We got our own money here. We're drinking and eating our own food here. So this is something that's really dear to our hearts. And it's something that I think is going to stay that way.
Yeah, I do too. And it's important. That you and I have charts like this built into stuff that we review every day. And the reason that we look at the portfolios this way and our accounts this way is because there's absolutely nothing in here in this chart that tells us anything about return.
Right.
It does not say a word about return.
That's right.
We stop counting it when it gets to zero. Every time you see it hitting this top line here, our portfolio or the market is making a new high. We don't care. That's again, we're interested. How much time and how deep do we have to spend below this zero line? This is zero up there at the top. Every time we're at zero means we're making a new high. And the market does the same thing here. But on a comparison basis, again, I go back to not even thinking about return here, which is going to let you sleep better at night. Well, those blue icicles are much less difficult to tolerate than these red monster stalactites that are hanging down from the upper ceiling there, because this chart explains why we can take so much less risk, and yet over time we're looking at essentially the same return between the two of them. And that's not on this chart, but again, this is what drives us. And you look over here, and we're at we're down in this portfolio, but we're down at 1.75%. That doesn't worry us. That's noise. That is, and we've been there before lots of times. Lots of times. The return is going to depend on what the market provides us. We can't control that. You and I are hearing, people who specialize in forecasting that the next 5 years or the next 10 years, because of where valuations are right now for stocks, that it's unlikely that we're going to see much more, than 3 to 4 annualized percent annualized return over the next half decade or a decade.
Right.
Well, if that happens, we can't make money if stocks don't go anywhere. But what we can control is we can control how much risk we're going to take. So we focus on charts like this. We protect against downside, so that even if the markets aren't giving us a lot, we're going to take as much advantage of that as possible, because we're going to spend so little time trying to crawl out of massive crevices with our capital, like this red one here from the global financial crisis on the S&P, or like this one, like the coronavirus here, like this one in the fourth quarter of 2018, which no one quite understood, and we just didn't participate in much of that. They climb back quickly, but we just don't have to climb as far. So that's kind of an insight into the way that we think, the things that we look at, and the reasons that we put our money into these kinds of things. So I hope that explains something to folks.
Well, it's important for us to articulate. Hey, for a Georgia redneck to articulate anything would be a stretch, but it's a belief, and of all the things I can tell you about the future, we're not going to change the part about volatility control, because it's the thing that is most important when you really get down to it. So,
Absolutely is.
that was good job today.
Yeah, I hope we made our point.
Yep. Yep.
We'll invite anybody watching this that if you like it, hit subscribe down below. We do these about twice a month, and feel free to comment below and contact us anytime with any questions that you have. We use the contact form on our website, stonebarnportfolios.com, if you want. That's the best way to do it. I'm going to try to take a little time off next week, Don, and it's a harvest time here on the farm, and I'm a little behind on the lavender, and I've got vegetables coming on like crazy, and I'm going to start putting some of them up and saving some of them. I'll be in the office for an hour or two each day, but I'm gonna try to sneak out and get sunburned.
Well, I am too, except I'm going to be fishing. Fish are starting to bite down on the lake, and so we'll reconvene if anything comes up that's earth shaking. But hey, our models drive our decisions, and so we're not going to do anything under most conditions that is out at the month's end. So have a good week.
I'm going to do my best. You do the same.
Yes, sir.
See you.